You know what separates the rich from everyone else? The rich make their money work for them, while everyone else works for money. And the way they do it is simpler than most people think. Imagine your friend Marco opens a pizza shop. He needs $10,000 for ovens and ingredients. You give him $1,000 and in return, he gives you 10% ownership of the business. That means you now own part of the company. The pizza shop becomes a hit. 6 months later, someone offers you $5,000 for your 10% share. Your $1,000 investment just turned into $5,000. But you could also keep your ownership and let the value grow even more. That is exactly how stocks work. They represent ownership in real businesses. A stock is simply a small piece of a company. When you buy shares in Apple, Tesla, or Amazon, you own a tiny part of that company. When the company earns money and grows, your investment can grow too. You earn money in two main ways. First, the stock price rises. If you buy Amazon at one price and sell it at a higher price, the difference is your profit. Second, some companies pay dividends. These are payments made to shareholders simply because they own part of the company. It is similar to receiving rent from a property you own. Today, investing is not just for wealthy people. Anyone can start with as little as $5. You can buy fractional shares, meaning you can own a small portion of expensive stocks without needing the full share price. One advantage most beginners underestimate is time. The S&P 500, which represents the 500 largest companies in the United States, has averaged about 10% growth per year over many decades. If you invest $10,000 at age 25 and leave it untouched until age 65, it could grow into hundreds of thousands of dollars. Your money grows, then grows on top of that growth. This effect compounds over time, but stocks do not move in a straight line. They rise and fall. Market crashes happen. Many people panic and sell at the worst time. Experienced investors see those moments as opportunities because they understand that they are buying pieces of real businesses that continue to produce products and services even during downturns. The easiest way to begin is with index funds. Instead of choosing individual companies, an index fund lets you own small pieces of many companies at once. It spreads your risk and provides steady long-term growth. Even Warren Buffett recommends index funds for most people. Here is a simple starting strategy. Download a trusted investment app. Create an account. Deposit an amount you are comfortable with. Even $20 is enough. Buy your first share or index fund. Then continue adding small amounts regularly. Consistency is more important than trying to time the market. The best time to start investing was years ago. The second best time is right now. Every day you delay is a day your money could have been growing. Wealthy people aren't necessarily smarter. They simply start earlier and stay consistent. Make your money work for you instead of spending your life working for money.